What's one thing investors hate almost as much as poor returns? Uncertainty. And there's been plenty of it thanks in part to the Trump administration's tariff war. Those fears have sent the price of gold surging to a record high. But is the yellow metal really the safe haven it's touted to be? And can it protect your portfolio from the fallout of this trade war? Let's explore if gold can keep its glitter. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. We've got a timely topic for you today. Is gold all that it's cracked up to be during times of uncertainty? We're going to size up gold's historical performance during turbulent times and what that might mean where it's heading later this year. Plus, we're going to hear about the potential benefits of holding physical gold bullion when times get tough, and an easy way to do it. And of course, we're going to take your questions about investing in gold in our live Q&A session later in the show, so stick around for that. But for now, let's bring in our guest speakers here. Joining us in studio is Bart Melek, Managing Director and Global Head of Commodity Strategy at TD Securities. And over in Ottawa is Frank Caterina, Program Associate for ETR Investor Relations at the Royal Canadian Mint. Gentlemen, it's wonderful to have you both here with us. Thanks for taking the time.
So good to be here.
Thanks for having me.
Yeah. And Bart, I want to start with you here. Thanks again for joining us in studio here. You've been the TD Metals guy for a long time now, and I'm just curious to get your take on where gold got this reputation as a safe haven during times of uncertainty.
Well, reputation is well-deserved because much of the time it has performed quite well in both absolute and relative terms during periods of extreme volatility and extreme angst. If we go back to a period of the financial crisis in 2008, 2009, where we essentially had a meltdown of the financial system, virtually every major asset class was collapsing, and that included, problems with treasury markets. Yes, gold corrected as well at the time, but it outperformed in relative terms. It did better in relative terms than more other asset classes. And then when the central bank materially cut rates and went into quantitative easing, the zero bound, gold surged, outperforming, a lot of assets, and here we are today at 3,300. We were just recently at 3,500. So gold did pretty well during a period of great turbulence over the last several decades. You go back to the pandemic, and as well, gold reacted negatively as everything else did. These are liquidity issues quite often, but then it did pretty well. This year, while equities were languishing, gold, I think, if I stand correct, is up 24% year to date. So I would say it has done pretty well, and it has, I think, earned its reputation as a hedge throughout history during times of extreme volatility.
Okay, well, there's obviously crises of different flavors here. So we're going to dig into the historical performance here a little bit and kind of what that might mean for the future. But Frank, over in Ottawa, I'm curious, the Mint offers physical gold products that investors can buy and hold, perhaps in times of uncertainty as well here. I'm curious if you've seen demand for these types of products rise during past crises and also the current market uncertainty that we're seeing.
Well, without getting into the sales figures, in recent months, what I can say is that we've seen quite an active market for both buyers and sellers. So what tends to happen when gold prices rise strongly is that we see those who may have purchased earlier at lower levels sell back to the dealers to take some profits. So, so we're seeing an active resale market. Recently, viewers may have seen some Royal Canadian Mint products on display at Costco. So that's something that's new in recent months. It's gotten some media attention and certainly a new development. So that's about what I can say on that.
You really can get everything at Costco these days. It's incredible here. We're going to hear more from you later in the show, Frank, about a really interesting gold product that investors may not have heard about before. So hang tight with us here. But first, I want to get to the heart of our conversation with Bart here. Is gold truly the hedge against uncertainty and volatility in Trump's trade war? And of course, for those in the audience, if you want to get in on this conversation, make sure you submit your questions to us. If you're watching on Web Broker, you can use the chat box. If you're using our broadcast platform, check out the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your questions there. Okay, so let's get down to business here. Bart, you talked a little bit about gold having this good reputation as a safe haven during times of uncertainty here. Take us through what we've seen this year with gold.
Well, this year has been, I think, by all measures, a phenomenal year. What do we have happen? Well, we had Mr. Trump take over the White House, and he came out with very robust and, some would argue, disruptive policies on trade in the form of tariffs. For quite a while, we weren't sure what form that would take. I would argue we still don't know. But, to the question of gold, many traders around the world believed that gold may too be encompassed in this trade war, facing a 25% tariff. Well, what was the market reaction? Well, the market reaction was to move all the gold you possibly can and deliver it into the United States before we would see the tariffs hit. As it turned out, the tariffs never did. But what was the mechanics? What were the mechanics of it? Well, there's plenty of gold, but there wasn't enough gold of a particular so-called good delivery form that could be brought into and delivered against COMEX contracts in the United States. So what we had to do is we had to, take a bullion bar from the Bank of England, for example, or the LBMA system, send it to a Swiss refinery, make it into a kilo bar, let's say, or a 100-ounce bar that's good delivery for the COMEX. That, of course, takes time, and then ship it over. And that essentially created a perception that we were running out of gold. And we've seen traders move millions and millions of ounces across the Atlantic. That stressed the bullion market a little bit, because you can only, retrieve physical gold from the Bank of England so quickly. It's a 1,000-year-old plus institution. It's not exactly, modern docks and all that. And the market was worried that we were running out of gold. Prices in the futures market surged much above the physical. We call it the EFP, exchange for physical. And we've seen, CTA funds, systematic funds, get into the trend, pushing it up. We've seen at the same time central banks were buying and continue to buy. We can talk about central banks a little later. And a lot of investors in Asia in particular were very interested in gold. And we've seen the metal surge as these perceived scarcities were created. There was, we call it tightness, particularly on the front end, the short end, because it was difficult to source. And we've seen record prices. And then at the same time, we started to worry about tariffs and what impact that will have on inflation. Well, you've often heard that gold is an excellent hedge against inflation, but it's more than that. It's a hedge against inflation given a particular monetary policy. And we've seen the President of the United States from the White House strongly encourage the Federal Reserve, the U.S. central bank, to lower rates. Well, that's kind of unorthodox. When inflation is moving higher, you typically don't necessarily want to lower rates. You might want to keep them, in a restrictive mode or lift them. Well, even the fear of interference in the interest rate market got some spec investors to buy gold as a potential hedge, because we were expecting, real rates to maybe go lower. So inflation higher and rates lower. That is usually a very good story for gold.
Can you help us understand, though, what is it about gold that makes it an effective hedge? What qualities does it have that would lend itself to that?
And that is a story I've been telling central banks for many, many years. And I'm certainly not claiming credit, but I think the idea of gold got through, because since 2022 they've been buying it at a record pace, and well over 1,000 tons in 22, 23, 24. And why is gold protection against inflation, or why does it help you preserve purchasing power? And the answer is, I think, relatively simple. One, it's nobody's liability. In essence, it means it's got intrinsic value. If you have an ounce of gold or a kilo of gold, you have a kilo of gold. You don't necessarily have to rely on anybody's good graces or sticking to a contract to pay up a dividend or pay out a coupon or repay you your debt. You have gold, you can trade it, it's got value, it's intrinsic. So, traders would say and bankers would say there is no counterparty risk. Government can default, you don't care, you have it. Second of all, it is a real asset. You can't just print it. You can't go on the computer key and go, well, you know what, today I'll create $1 trillion of fictional money, I'll put it in the debt, in debt markets, and, Bob is your uncle. Well, you got to go into a mine site and you got to start digging. Well, what does it take to get an ounce of gold out of the earth? Well, you need labor. You need productive capital. You need big machines with the big wheels. You need everything from water pumps to transformers. Then you need to go take the concentrate, make it into doré, then move it to a refiner, and then you have your ounce of gold. Well, typically we know that over time, labor costs tend to follow inflation. You certainly will have situations where maybe a year or even several years, inflation outpaces labor, but then people get upset, withhold work, and all those sorts of things lead to labor costs moving higher. So if you need X amount of units of labor to extract that unit of gold, well, inflation moves the price of labor. So that's a natural hedge. At the same time, as we found in the post-pandemic era, that capital goods also respond to inflation. We had a period of inflationary pressures. You had issues, and the cost of capital went higher as well. Well, so we can almost say by definition that over time, gold costs will reflect the price of these factors which are hedged to inflation or respond to inflation, just because that's the world we live in. And we know, from our research, we have data going back some 45 years, that on the margin, the 95th percentile of the global cost curve, meaning, the marginal producer, is very much linked to the price of gold. In essence, as cost of production goes over time, the gold price trends along with it. And sometimes it's the chicken and the egg, one drives the other. But we see a consistent relationship between the cost of production and the cost of gold. And if you are a central bank, let's say, or an investor, and are worried that governments are going to create massive debt and potentially monetize, where real returns on your fixed income assets or your government bonds are going to be at below inflation, then you look at gold and saying, well, this thing kind of gives you inflation every time over the long run, maybe not consistently every year, but over 50 years, you're pretty sure it's going to reflect inflationary developments. So it's not a bad alternative. And you've got another factor, I think a third extremely important factor. The quality of ore in the ground is becoming, guys like me will say, inferior, but now you have less gold content for every ton of rock and dirt you excavate from a mine than you did 30 years ago. Well, it's a simple reason. The easy stuff was retrieved first, and now you don't have the super high quality gold assets as you did before. You have to dig deeper, you have to process more ore to receive the same ounce of gold. So we overlay higher cost of capital on that marginal unit of cost to extract an ounce, labor. But now we have lower quality stuff we're dealing with from the ground. So again, and that's definitional, it's hard to argue with it. You're going to need more units of labor and more units of capital to extract every unit of gold using those more expensive, so-called factors of production. Well, that kind of gets you to, thinking that maybe even if the bond market isn't monetized, the fact that the resource base is getting, less and less robust, the real value of the real price of gold may outpace inflation because of all these characteristics. And that's aside from all the issues with the U.S. having $37 trillion worth of debt, less potential demand for U.S. treasuries, de-dollarization. And that, that's not even going there. This is just by pure physical fundamentals and how gold is extracted from the ground.
Okay, so lots of potential catalysts there. You sort of mentioned some of the issues that the U.S. is facing here, and I want to talk a little bit about that. There's obviously a lot of concern about this tariff war that's going on and all the geopolitical tensions around the world. In your view, is gold likely to outperform in a situation like that, given the factors that something like a trade war might produce?
I think so. So, tariffs. We don't know how this will end, but I think we can say with a very high level of certainty that the global market or there's less free trade now than there was a year ago. Probably this level of threatened tariffs isn't going to continue, but they're going to be probably higher than they were. And we also know that the tariffs that have been imposed have caused a significant reduction of flows of consumer goods into the United States. And what that essentially means that probably by year end, U.S. inflation could very well be, close to 4%. Depending who you ask, depending which forecaster you talk to. But no one is talking about, 2% and having hit the 2% target. And what else is happening? Well, this tariff war also, potentially likely means a significantly slower economy. We're seeing signs of that. Labor hasn't responded to the downside quite yet, but we think it will. And the Federal Reserve, unlike other central banks, has two prime mandates, three really, but two that are important to us. One is price stability, keep inflation at bay. And the second one is to create maximum employment environment. Well, that means we could have a potential situation at the year end. We think at TD that, in the latter part of the year, we will see two cuts, and the consensus in the market is pretty much the same as well, that we could see inflation move higher and a Federal Reserve that's cutting rates. Well, throughout history, pre-Mr. Volcker, we had situations like that. And it doesn't help that the Fed is talking about tariffs having a transitory effect on inflation. We've heard that term before during the pandemic, and inflation got a little bit out of hand, and then we had to get the most tightening in 4 decades. So I think in the short run, there is medium run, I guess. In the short run, we do actually think there might be a bit of a correction still. But when you look into the latter part of the year, we could envision a situation where you have rates going down and inflation moving higher. And that's going to, I think, catalyze markets to get excited about gold again. And we'd likely see, prices above where we've had them recently.
Yeah, I think one of the things too that investors often think of when they talk about investing in gold is this protection against stagflation. The inflation is going up, but the economy is going down. Is the tariff war likely, in your view, to kind of produce a situation like that? Because gold in the 70s just went on like a rip-roaring run when that happened. Are the conditions analogous in your view?
They're different because they're different. there are different supply shocks now. We have the tariff one, which is, I like to say, a negative supply shock akin to the oil crisis. But we also have a negative labor supply shock with much more stringent immigration measures in the United States. A lot of sectors like construction, hospitality, many other service sectors that did employ a lot of people that came in, maybe not through the official, sites to the U.S. I think increasingly they're getting shut out. So you're having potentially a negative labor shock as well. And tariffs could cause slower growth. Ultimately, that translates into less risk appetite because, markets are forward-looking or, so-called discount mechanisms, and they'll look and say, well, things are slowing, costs are going higher, maybe profitability isn't going to be there. And gold, we know over the last, the 40 years we looked at and longer, have been inversely related to equity prices. In essence, if equities aren't performing well, then gold does fairly well. Mm-hmm. There are other things involved, but broadly, that's the thing, except of course the TSX, because the TSX is very gold heavy and that one correlates more with gold. But I'm really talking more about markets like the S&P 500, which are very broad, industrial, tech and others.
Mm-hmm. The other thing too that we hear a lot about these days in the headlines is like the exploding U.S. debt situation. And certainly with the big beautiful bill here, the expectation is that there could be a lot more U.S. debt that the government there is taking on. How does that play into the story for gold? Like, why could that be a potential driver for gold?
Well, the driver is a big one, and high debts are at the center of it. So right now, the United States has roughly, a little over, I think, $37 trillion worth of paper outstanding. And it's growing this at an alarmingly fast rate. We're talking, $2.2 trillion probably over the next 2 years. It's been trending 6% plus. The economy isn't growing 6%. So as a proportion of the economy, it's growing. And this particular bill, I haven't looked through all of it, but my understanding is there are robust tax cuts, some spending cuts, but in essence, it likely results in more paper or more requirements to issue debt. Well, if we go beyond, the next 10, 20 years, we've got, social issues going on demographically speaking, expenses on Medicaid for elderly who may need help, Social Security and other non-discretionary programs will likely grow. So the question is, how is this going to be funded? We've just seen taxes reduced, corporate and individual taxes, so less revenue and really no particularly robust plan to see expenditures go lower. Well, markets are quite worried that may mean you keep real rates low. In essence, you kind of monetize maybe the central bank buys it. And to add to all that, we're seeing less appetite from foreign buyers relative to the market. In essence, their share of treasury purchases is dropping. And Europe has discovered debt financing again because of all the now plans to increase spending on the military to 5%. Even Canada is including itself in that commitment, and that's all going to be debt finance. And Europe, in particular, likely finances trillions and trillions of dollars of new paper using some sort of Eurobond issues. Probably, we don't know how that's going to play out yet, but that's a very credible competitor to the very liquid U.S. Treasury market, and that could mean less demand for U.S. dollars, relatively speaking, and U.S. dollar underperformance. And we know that there is a very strong inverse relationship between the two. U.S. dollar weakness typically means stronger gold.
Mm-hmm. So let's kind of put this all together for people here. Let's say they're hearing what you're saying here, and they're looking at all these catalysts, saying, okay, maybe gold is something I want to have exposure to. One of the things to consider, though, is that stocks have tended to outperform gold over the long term. So is there, in your mind, like a time frame that somebody would need to hold gold for it to make sense? Is this more of like a short-term tactical type kind of play? Is it something that can be in a long-term portfolio? What's your view?
Well, I've never been smart enough to be tactical and pick the lows to buy and highs to sell.
That makes two of us.
There are probably a lot smarter people than me who can do that. I'm pretty simple. I think, and that's based on reading studies from the World Gold Council, looking at this more systematically, that its inverse relationship to risk appetite ultimately means that it's a good stabilizing factor, and then over time, some gold in a well-diversified, well-managed portfolio will increase aggregate returns for the whole portfolio, and that is intact with asset theory broadly, that you have an asset that's counter-cyclical to everything else. It'll if anything, risk-adjusted returns should increase because your volatility, therefore risk calculation, is better. So I think there are good portfolio reasons to have an asset like gold to be present, and that's based on a lot of studies that I've seen, and some from the World Gold Council.
Mm-hmm. Yeah, and kind of just to pull on that same thread, I saw an interesting white paper talking about the optimal allocation to gold, and they were pitching something like 17%, which seemed like totally out of line with other things I've seen, like in the low single digits and stuff like that. I'm wondering, do you have sort of a best practice or a rule of thumb for people to keep in mind?
Well, I don't. It's not really my business to develop efficient portfolio allocations, but it's not zero, and it's not probably 50%. So many people are talking about 10 to 15%, 5 to 15, probably somewhere. But I think that probably very much depends on what your particular goals are. So it's not zero. It's probably more than 5, but probably less than 20. It's tough to say, because I think it would very much matter what your portfolio looks like.
Sure, yeah. But anyway, kind of a rough idea for people to think of there. Appreciate you giving us the lowdown on gold here, what's happened, what might come here. Just a quick note to our viewers here. If you want to follow us on social media here, TD Direct Investing, we're all over it, okay? We're on YouTube, we're on Facebook, we're on Instagram as well here. So make sure to check us out here. You got QR codes on the screen that you can check out as well. Okay, Bart, appreciate you kind of sharing your perspective on gold and its role in the portfolio here. Remember, viewers, we have our Q&A segment coming up later in the show here. Make sure you get your questions into us before it's too late here. Again, if you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, use the questions and comments box. And if you're watching on our YouTube live stream, again, click on the link in the description and you can get taken over to the broadcast platform, and that's where you can ask your questions. And we'll get to as many as we can before the time is up here. All right, I want to go back to Frank in Ottawa here. We heard about the value that gold can potentially bring to a portfolio here. I want to talk about a really interesting product related to physical gold, like gold bars, gold coins, and stuff like that. So, Frank, can you fill us in on the case for physical gold? Like, why would somebody want to hold physical gold versus something like, like a gold ETF or something like that?
Well, I mean, when you consider that a key reason to hold gold is as a hedge against general market chaos, it may make sense to have some gold holding. We have certainly seen that play out over the last several months with the tariff situation. And again, not that long ago, at the outset of the COVID pandemic, just to use a couple examples. So basically, you want to have something tangible when times get crazy economically and or geopolitically. So storing gold, can be cumbersome. So having a gold listing, such as an ETR, which we'll get into more, makes a lot of sense, I think.
Yeah, tell me about this. You brought it up there, ETR, Exchange Traded Receipt. Probably not something that folks have heard of before. The Mint is one of the organizations that offers a gold ETR here. Take us through, what is this thing? How does it differ from an ETF, and what do you get when you hold an ETR?
Okay, so so ETRs they openly trade on the TSX just like other exchange traded securities. The Mint's Gold ETR is listed in Canadian US dollars, ticker symbol for gold. If you want to bring it up on WebBroker, in Canadian dollar terms is MNT, and for US dollar gold, the symbol is MNT.U. So in a nutshell, it makes investing directly in physical gold easy for retail investors. As opposed to buying gold from a dealer who will charge you a premium when you buy it and give you a bit of a discount when you turn around to sell it. It's noteworthy that your household insurance won't cover gold bullion, and you have to consider how you're going to store it, of course, safely. So the ETR program is essentially an innovation on our longstanding storage services. So we've always stored gold, but for like large institutions, banks, very wealthy families. But now with the ETR, anyone with as little as 1/100 of an ounce of gold or one exchange traded receipt, one ETR, can have the same quality storage as our institutional investors or customers with the convenience of a TSX listing. Just to go over the structure a little bit, each ETR represents direct, undivided, beneficial ownership in gold bullion held in Ottawa at the secure facilities of the Royal Canadian Mint. And there's no intermediaries involved, which add an element of risk. So we don't have like units or shares like a mutual fund or ETF. So the structure is what we would call it's like semi-closed end. So that means that the total number of ETRs outstanding will increase from time to time if we do a follow-on offering or private placement, and they'll shrink in the event of monthly redemptions for physical gold or cash. And it's also noteworthy that ETRs are eligible for all Canadian registered accounts. So the new first home savings accounts, RRSPs, RESP, tax-free savings accounts, etc. They can be held in those accounts.
Yeah, just taking a look at some of these visuals on screen here where the Mint is producing gold here. I'm going to go out on a limb and say having the Mint hold your gold for you is probably a little bit more secure than tucking it under your mattress with your cans of tuna in your bunker. Just going to go out on a limb here. But so you've talked about some of the potential benefits of a gold ETR. In the interest of fairness, what are some of the potential downsides? Like, what are you giving up when you hold a gold ETR, let's say, versus something like a gold ETF?
Sure. That's a very good question. So one important consideration is in terms of the structure of the ETR. It's semi-closed end, which means that it's possible that at times ETRs will trade at a varying premium or discount to the underlying gold value or the net asset value. So I would strongly recommend that people visit the ETR program website, which is reserves with an s.mint.ca. And if you navigate to the investor's net asset value page, you'll find this table called intraday net asset value. And there you can see throughout the trading day the current premium or discount to the net asset value prior to making any purchase or sale. And I want to point out that the gold ETR has been trading at a premium in recent weeks. So that's something to take a look at. Another point worth noting is that an ETF tends to trade at a tighter spread between the bid and the ask, and so we're certainly a wider spread, and the volume the trading volume is a little bit lower on the ETR as well. But we believe that the liquidity will improve as the program grows in size over time. And I also want to point out the annual service fee is 0.35% or 35 basis points. So there are some lower fee gold listings out there as well, but I think we still have some important advantages that investors should consider.
Mm-hmm. Yeah, that fee is pretty analogous or comparable to a lot of the gold ETFs out there too. So it's not like wildly more or anything like that. I want to push back on something. I'm sure all the preppers out there might be wondering this. This idea that part of the reason you'd want to hold physical gold when times get crazy is that you have it on hand and it's ready to rock here if you need it in some kind of worst case scenario. So like, what would you say to the skeptic who's saying that, well, if I have an ETR, is it really all that different than holding like a gold ETF or something like that, rather than actually holding the physical gold itself?
Well, with respect to gold ETFs, I'd say the one really important distinction is that the ETR is backed by the Canadian government. There's no other gold investment listing out there that has that level of security, government backing. And in terms of holding like physical gold, it's not that is without risks, right? You need to pay for insurance. Your household insurance specifically does not cover gold bullion. So you have to pay to insure it and store it, or take on the risk of loss and theft. So with the ETR, you avoid all those issues, and you can park it in a registered account to defer or avoid tax, like a tax-free savings account, for example.
Okay, I think the question on everybody's mind here, and I asked this a little bit tongue-in-cheek, but curious nonetheless. Can I go visit my gold in the vault? All right, can I go check it out? Can I make sure that it's staying warm and all that stuff like that in the vault? Can I check it out?
Well, as you can imagine, we've got some pretty tight security protocols. So unfortunately, we can't let people go visit inside the vaults. But however, I can say that both in Winnipeg and in Ottawa, where I'm based, we've got some really informative and highly rated tours where you walk along the catwalk and you can really get a good look at our operations and check out some of our beautiful new coins afterwards in the boutique. And I definitely recommend it if you happen to be visiting either city.
Yeah, just another excuse to go to Ottawa, beautiful town. Thanks for filling us in on that, Frank. Really appreciate it. And to both of you guys, Bart and Frank, really appreciate you guys filling us in on gold, the case for gold here, and some of the levers that we could see here. I want to open the floor and take some questions from our viewers now. You've submitted your questions. We want to hear from you. So let's get to our first question here. I have one coming in here from Ramesh. Ramesh is wondering, do you see crypto eventually overtaking gold as the go-to safe haven? Bart, I think this one's for you.
That is a question I get a lot. I don't think so. I think crypto is one thing and gold is quite another. I know that there are some intersects between the two, the investors who will have both. But I think for the most part, gold is geared to different client sets than crypto with some overlap. So I don't think one is going to benefit at the expense of the other, is the short answer. Right.
So, I mean, if they speak to different markets here, like what are those different markets, do you think?
Well, if you're really worried about an existential problem where you're going back to a time of no electricity, no computers, good luck if you have crypto. Your phone doesn't work, your compute doesn't work, and your crypto won't work. And there are those. That is why they're buying it. Central banks, for example, are very much interested in gold as part of their reserve. In fact, for the first time since the Bretton Woods system, we're seeing the holdings of gold in aggregate holdings in FX reserves by central banks outpace the euro. And, I've not heard of any central bank talk about buying crypto. And one thing I will mention about crypto is it's not really a unique asset. Any one of us can set up a crypto coin or a crypto currency. There are ones that are unique, but there are other ones that aren't, and we'll ultimately see who's going to dominate and how, and gold is just gold.
Mm-hmm. Okay, good perspective there. We have another question coming to us from Paul, and Paul is wondering, is it true that the Canadian Central Bank sold all its physical gold over 10 years ago and is now buying it back? Frank, I don't know if you can speak to this.
One thing, I believe that's the case, but I know that in the Bank of Canada Currency Museum, there's something like 30 odd ounces of gold. So that's there for sure. But in terms of central bank holdings, I couldn't tell you.
Bart, I don't know if you have any insight on that one.
Yeah, I mean, as far as I know, the Canadian Central Bank, the Bank of Canada, does not hold any meaningful amount of gold. And no, I've not seen the Canadian Central Bank participate in any gold purchases like the Central Bank of Poland or People's Bank of China has. So no.
Okay. Harley's got a question here, wondering, is there a silver ETR too? Frank, fill us in.
Yeah, there absolutely is a silver ETR. So the symbol is MNS for silver and Canadian dollars, and for US dollars, you have the .U. MNS.U. It's essentially very similar in terms of redemptions. The minimum to redeem is 5,000 ETRs, which is about 3,000 ounces. In the case of gold, it's 10,000 ETRs, which is about 105 ounces. And the service fee is 45 basis points, so 0.45%, because silver takes up a little more room in the vaults relative to its value.
Okay, so there's a silver out there too. Bart, I'm wondering too, just put you on the spot here. I know we were talking gold, but talking silver here. Is there a similar dynamic going on with silver as there is with gold as a safe haven asset that investors want to consider, or not really? It's kind of its own thing.
I think there's definitely an element of that. Traditionally, gold and silver go hand in hand. Not always, but they tend to travel together. And the characteristic here is that gold volatility is one half of silver, and the implication here that in a really strong bull market, there tends to historically be a bull silver market, except that it outperforms. So if gold is moving up by 1%, silver would at that time move 2. Always doesn't happen. It hasn't really happened, lately, and part of it is because we are worried about industrial demand. We are worried about tariffs, and silver is still very much an industrial metal as well. It's more of a hybrid. It's a half monetary metal like gold, and the other one, is like half copper industrial, where 60% of its demand is for industrial uses, from the chemical industry to ring manufacturing to catalysts and other things.
Mm-hmm. Okay, so some similarities, some differences there. Good to know. Thanks for filling us in there. Rahul, let me get to this question here, has a question for us. Should I be concerned about low liquidity for the Royal Canadian Mint's ETR, especially the US dollar version? Does the Mint have market makers that can ensure that I can always buy or sell at a relatively reasonable price here? Frank, maybe you could speak to that?
Yeah, I mean, there's certainly market makers with both TD and National Bank. The U.S. dollar denominated ETR is definitely not as much trading volume. It tends to trade in Canadian dollars, which you would expect being in Canada. Again, I think that over time we're looking at ways to improve liquidity, and I think that as it grows, that it is going to be trading at higher volume. We would expect.
Okay, good to know there. Appreciate you filling us in. Janice has a question as well here. Janice is wondering, what are the different options for adding gold to my portfolio and some of the pros and cons of each? Bart, maybe you could speak to this.
Well, look, one, we have already talked about the stabilization factor and its counter cyclical nature, where it does well when risk appetite drops, and that implies things like if equities aren't doing well, gold tends to do okay. So there is that benefit. Benefit is that it reflects in inflation. Some of the drawbacks is that you're not going to have the same type of performance as you would have with some of the more extremely well performing tech stocks. It's a different type of asset. It's not meant to give you 100% an annual return. It's something that's you might want to have exposure to stabilize your portfolio and keep purchasing power steady, as opposed to something that generates you a constant flow of dividends. Because I think for most investors, gold doesn't yield you a return like a bond would through coupons, or a stock through dividends. So they're different assets. We could talk about how gold in fact does pay an interest rate, but that's really just for large institutional investors who are able to capitalize on that in various swap markets and so on.
Yeah, gets complicated real fast here. We have time for one more question here. This one coming to us from Stacy. Does the gold ETR track the price of gold as accurately as other spot gold ETFs? Frank, take us home here. What's your answer?
Well, as I mentioned, the structure is a little bit different than an ETF. So it can trade at a varying premium or discount, and it, again, is trading at a bit of a premium at the moment in the recent weeks. But it is also unlike a lot of ETFs, you can redeem it for physical on a monthly basis, and the threshold for redemption is lower than most other exchange traded funds. And at the end of the day, you've also got a government backing. So if you're a long-term investor, a long-term holder, ETR may be something to look at in your portfolio.
Right, yeah, another investment possibility to consider here for those who are interested. All right, gentlemen, really appreciate you guys taking the time here. It's been wonderful chatting here about gold, kind of demystifying a little bit of what can be a complicated topic in some respects here. So appreciate both of you guys taking the time here. We're going to have to leave it there for now, but we have our other show coming up here next week. We run the show every week. Make sure you tune in for that one as well. We're going to talk about one of the retirement-ready rules of thumb that you can follow, let's call it, the 4% rule. We're going to put it to the test here. We recently heard its creator question the validity of this rule, but there's still a lot of retirees that bank on this 4% rule. So we're going to take a closer look at this one. Is it worth considering, or have times changed? Tune in to find out. Thank you so much for tuning in. That's all the time we have for this episode, though. From everyone at Inside Investing, appreciate you taking the time, and we'll see you all next week.
Have more questions? Check out the links to the right and in the description below.